It's already happening. The gold-silver ratio didn't compress from 62.05 to 54.94 in a single week because of one trader's bet. The ratio didn't drop nearly 12% in 7 days because retail piled in. Silver didn't gain 7.1% in a single session on May 11th, while gold barely moved because of speculation. And the entire metals complex didn't rotate the way it did because of a single news headline. The ratio is in the panic zone, and not for the doom niche reason most channels use that phrase. It's in the panic zone because the institutional traders who model these compressions for a living are seeing the exact pattern that preceded silver's biggest historical moves, from 88 to 1 in early 2024 to 54.94 today, with a sub-50 touch in late January when silver crossed $121. Silver gained 144% in 2025. Gold gained 65%. That's silver outperforming gold by 2.6 in a single year, the largest annual outperformance gap in over a decade. April CPI just printed at 3.8% above forecast. The Federal Reserve voted 8-4 on April 29th, the most fractured FOMC vote in 50 years. Kevin Warsh just confirmed on a 13-11 party line vote, the first fully partisan Fed chair confirmation in committee history, and the gold-silver ratio at 54.94 is below the post-2000 average of 60 to 65, territory that has historically marked the start of silver leadership phases, not the end. Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through exactly what the gold-silver ratio at 54.94 is signaling structurally, with the actual data from the May 11 compression and the year-over-year outperformance numbers. I'm going to show you why the single-week move from 62 to 54.94, driven entirely by silver while gold barely budged, is the cleanest signal of an industrial monetary metal divergence the market has produced in years. I'm going to give you the historical compression sequence at every major silver peak: 17 in 1980, 31 in 2011, 47 in January 2026, with a specific mechanism that produced each one. And I'm going to give you the 4 signals that will tell you whether the compression has entered its acceleration phase or whether the next leg pauses first. Quick favor before we go further: subscribe. If you want clean breakdowns when cross-asset structural moves actually matter, not hype, not cheerleading, just the mechanics, hit the bell. Ratio compressions don't announce themselves through press releases. They announce themselves through silver leading days the financial press underreports. Let's get into it. Let me start with the May 11 move. Because in a single week, the silver-gold relationship told you everything about where we are in the metal cycle. On the morning of May 5th, the gold-silver ratio sat at 62.05. Gold was trading near 4,210. Silver near $76. Over the weekend, the United States and China announced a 90-day tariff truce. U.S. tariffs on Chinese goods dropped from 145% to 30%. Chinese tariffs on U.S. goods fell from 125 to 10. Gold's reaction by Monday morning was muted, maybe a 0.5% move. The traditional safe haven framework said the geopolitical relief should weaken gold. It barely did. Silver's reaction was completely different. Silver gained 7.1% in a single session. By Monday afternoon, silver was trading at $86.10. By the end of the week, on May 11th, the gold-silver ratio had compressed from 62.05 to 54.94, a near 12% move in 5 trading sessions, driven almost entirely by silver. Gold contributed about 0.5 percentage point to the compression. Silver did the rest. That split is the cleanest signal the metals market has produced in 2026, because when both metals rally in unison, the ratio doesn't move much. They're both responding to the same monetary catalyst. When silver moves in isolation, the market is pricing something specific to silver. And what's specific to silver and not specific to gold is industrial demand. The Silver Institute estimates roughly 60% of silver's annual consumption goes to industrial applications: photovoltaics, electric vehicles, semiconductors, AI data center buildouts. Most of that supply chain runs through China. When the tariffs came down, traders repriced silver's demand outlook immediately, in one session. But here's the part the financial press underreports. The tariff truce removed a ceiling. It didn't create the floor. The floor was already there, built over 5 years of structural deficit, drained inventories, fragmented physical markets, and central bank gold accumulation that strengthened the entire metals complex. Silver was already structurally underpriced relative to gold at 62 to 1. The truce just gave the market permission to acknowledge what was already true. So here's the first lesson. The gold-silver ratio at 54.94 isn't an extreme reading. It's still above the historical bull market lows of 17 and 31. What's extreme is the velocity of the compression, the fastest one-week move in years. And the fact that it happened on silver-only buying, while gold sat still, tells you which metal the market has identified as the leadership trade for the next leg. Let me get more concrete about why this matters. Because the ratio compressed sounds abstract until you understand the desk-level conversations producing it. Picture an institutional commodities trader at a New York bullion desk, Tuesday morning, May 5th, 2026, 7:33 a.m. Eastern Time. He arrives at his terminal and immediately pulls up the cross-metal feed. The weekend headlines have already moved the futures market. Silver is up 4.8% in pre-open. Gold is up 0.2%. He runs the ratio calculation, 60.8 and falling. He'd spent the previous Friday at 62.05. He pulls up the year-over-year performance. Silver plus 144% in 2025. Gold plus 165%. That's a 2.2x outperformance ratio. He pulls up the historical comparisons. The last time silver outperformed gold by more than 2x in a single calendar year was 2010, when silver gained 84% versus gold's 30%. That cycle continued for another 5 months before silver peaked at $49.20 with the ratio at 31. He pulls up the Silver Institute's projection for 2026, sixth consecutive annual deficit, 46.3 million ounces. He pulls up COMEX registered inventory, 79.88 million ounces. Coverage at 13.4%. The seventh consecutive month below the 15% stress threshold. He pulls up Shanghai premiums, still elevated at 8 to 12% over LBMA. The physical market hasn't normalized. The futures market is what's catching up. He writes a single sentence in his pre-market memo to portfolio managers. Ratio compression entering acceleration phase, consistent with prior bull market leadership transitions. Maintain silver overweight, add on weakness. He sends it out at 7:51 a.m. By the time the New York session opens at 9:30, 3 other major bullion desks have circulated nearly identical notes. The institutional positioning shift isn't speculation. It's the same conclusion arrived at independently from the same data. That conversation is the floor under everything happening on the chart. Not retail enthusiasm, not doom niche conspiracy. Professional desks reading the ratio compression and adjusting allocations accordingly. The compression isn't happening because the institutions believe in silver. The compression is happening because the institutions can read the historical pattern and respond to it. So here's the second lesson. When the gold-silver ratio compresses on silver-only buying, the institutional reading is unambiguous. Silver has entered the leadership phase of the metals bull market. That phase has historically produced outsized returns. The ratio at 54.94 is the early stage. The historical bull market lows of 17 to 32 are where this pattern has ended in previous cycles. The current cycle has not yet produced its peak compression. And here's the part of the analysis that the doom niche misses entirely. This isn't just a story about silver futures. This affects what an ordinary family pays at the grocery store this weekend. The bond market noticed the same data the bullion desks did. The U.S. 30-year Treasury just cleared 5% at the May auction, the first time long-duration yields have crossed that threshold consistently since 2007. Fixed income investors are demanding 5% compensation for lending to the U.S. government for 30 years. That's a market vote of confidence in long-term inflation. And when long yields stay above 5%, while CPI prints at 3.8%, every household in America that wants to buy a home, finance a car, or refinance debt faces a tighter constraint than the official inflation rate would suggest. The average price of ground beef in the United States just hit $7 a pound for the first time in recorded history. Not adjusted, not seasonalized, actually $7 at the checkout counter. That figure has surged 77% since January 2020. The Federal Reserve has spent 2 years insisting inflation is controlled. The grocery aisle says otherwise. The disconnect between the official statistics and the lived reality at the checkout counter is the largest it has been in modern American history. And the bullion desk traders, watching the ratio compression, know exactly what that disconnect means. Capital cannot stay parked in assets that depreciate faster than the price of basic necessities. So, when the doom niche channels show you the gold-silver ratio and the macro setup as abstract financial data, they're missing the consumer-level confirmation. The same forces driving the ratio from 62 to 54.94 are driving ground beef to $7 and mortgage rates above 7.5%. Different markets, same underlying signal. The dollar's purchasing power is being repriced. The metals are catching up first because they're liquid and price discovery happens in real time. The grocery store catches up next because retail prices are stickier. The wage cycle catches up last. Now let me put the historical pattern under a microscope. Because each prior major silver bull market featured a specific ratio compression, and the mechanism behind each one tells you what to expect. In January 1980, the gold-silver ratio compressed to 17 to 1 at the silver peak. Silver hit $49.45. Gold hit $850. That 17 reading represented the most extreme silver outperformance in modern monetary history. The mechanism was specific. The Hunt brothers had been accumulating physical silver for over a year, taking delivery month after month and depleting registered exchange inventories. The compression measured the catch-up trade of a metal that had been suppressed at $4 to $6 for most of the 1970s, while gold ran from $35 to $850. When silver finally caught up, the move was violent. Silver gained 100% in 1979 and 1980 combined. The 17-to-1 ratio was the signature of that catch-up phase completing. In April 2011, the ratio compressed to 31-to-1 at silver's secondary peak. Silver hit 49.20. Gold was at 1920. The mechanism was different. Post-financial crisis monetary expansion had produced sustained dollar weakness, and silver had been outperforming gold by approximately 4-to-1 over the preceding 3 years. Industrial demand from emerging market electronics manufacturing accelerated the move. The 31-to-1 reading captured silver's full bull cycle leadership phase. Anyone holding silver instead of gold during the 2008 to 2011 compression, when the ratio went from 80 down to 31, captured roughly 2.5 sacks more upside per dollar invested. In March 2020, the ratio briefly spiked to 125-to-1 during the COVID deflationary panic. That was the opposite extreme, the most severe silver undervaluation in modern records. Silver had been crushed by industrial demand fears, while gold held up as a monetary refuge. The compression from 125-to-1 back down to 64 by August 2020, a 49% reduction in 5 months, was the recovery phase, with silver more than doubling while gold gained 30%. The pattern repeated. Industrial monetary divergence resolves through silver catching up, not through gold falling. In January 2026, the current cycle, the ratio touched 47.3, the first sub-50 print in 14 years. Silver was at 121.64, gold at $5,580. The compression came on the back of accelerating central bank gold buying, sovereign reserve repositioning, the broken Chinese silver export restriction arbitrage, and structural deficit. Then the correction. The ratio expanded back towards 62 by early May, and the May 11th move took it back down to 54.94. The pattern of the current cycle is the same as prior cycles. Compression, consolidation, then another leg of compression, at a faster pace because the structural setup is more developed. Is the historical pattern guaranteed to produce another sub-32 reading? No. Each bull cycle has unique characteristics. What's not arguable is that the historical pattern exists. The current trajectory matches the early stages of prior major compressions, and the institutional positioning is consistent with what produced those prior moves. Peter Schiff put it cleanly in a recent interview. A bond market crash is the most bullish thing that can happen for precious metals. Traders just haven't figured it out yet. The 30-year Treasury crossing 5% while metals consolidate and the ratio compresses is exactly the macro configuration Schiff is describing. The bond market is signaling sustained inflation. The metals are responding. Silver, with its industrial demand component, is amplifying the response. Let me give you the bear case fairly, because intellectual honesty separates this analysis from the noise. The bear case against continued ratio compression is real and worth respecting. UBS recently cut its year-end silver target to $80, citing demand destruction concerns. TD Securities' Bart Mellick published a $44.25 average for 2026, the most bearish call on the LBMA analyst panel. The Reuters poll of 30 analysts produced a 2026 median of 79.50, essentially flat from current levels. The substitution risk in silver's industrial demand, Longy Green Energy's copper-based solar cells launching in Q2 2026, semi-solid battery technologies that don't require silver, represents genuine long-term demand pressure. And the 2024 to 2026 compression has already done substantial work. Silver gained 144% in 2025. Gold gained 65%. Some of the catch-up trade is already in the price. The technical bears point out that silver has tested the $80 to $87 zone repeatedly and failed to sustain breakouts. The 50-day moving average is actively capping rallies. A weekly close below $75 would invalidate much of the bull thesis. The ratio could expand back towards 70 if industrial demand cracks during a stagflationary recession. These are real arguments. They might be right. What the bear case doesn't disprove is the structural setup. Even if industrial demand softens, silver retains its monetary metal status. The ratio at sub-50 readings has historically required substantial absolute silver appreciation. The compression can stall, but the underlying drivers, central bank gold accumulation, the broken Western-Eastern arbitrage, the sixth consecutive year deficit, the Fed paralysis at the 1971 style threshold, don't reverse easily. If Bart Mellick is right about $44 silver, the bull case for the year is dead. But the structural data doesn't currently support that conclusion. The data supports continued compression with periodic consolidation pauses. So ask yourself, when the ratio has compressed from 88 to 54.94 over 15 months, when the May 11th single-week move was driven entirely by silver, when historical bull market peaks featured ratios of 17 to 32, when current institutional gold targets, JP Morgan at $5,000, Citi pushing $5,400, imply silver prices of $100 to $150 if historical ratios apply, and when consumer prices for basic necessities are hitting records that contradict the official inflation narrative, what does the current 54.94 reading represent? The end of the move, or the early signal of the next phase? Now let's read the current action like a forensic report. The forensic case for continued compression is built on signals converging in the same direction. The May 11th single-week move was silver only, confirming industrial demand-driven leadership. Year over year, silver outperformed gold by 2.2x in 2025, the largest annual outperformance gap in over a decade. Junior mining stocks tracked through GDXJ held their breakout above the multi-month descending trend line through the recent paper market shakeout, signaling institutional positioning unchanged. Senior gold miners maintained their multi-month uptrend structure. Mining companies reporting first quarter earnings showed record cash margins. The selling has been concentrated in paper silver futures. The accumulation has continued in equity exposure and physical demand. You would also expect, in a market where ratio compression had completed, for institutional research desks to be flagging silver as overbought relative to gold. The opposite is happening. Bank of America's bull case at 135 to 301 an hour uses ratio compression as the price target derivation. Citi's stress targets at 150 to 107 imply continued compression. Michael Oliver's $300 to $500 framework is unchanged. The institutional bull voices have not capitulated. The bear voices are loud but increasingly isolated to forecasters whose models don't track physical flows. So here's the cliffhanger. The ratio at 54.94 is below the post-2000 average of 60 to 65. It's still above the historical bull market lows of 17 to 32. The institutional positioning is consistent with continued compression. The consumer-level inflation data confirms the underlying force. The May 11th single-week move was the cleanest possible signal of silver leadership entering its acceleration phase. The question is not whether the compression continues. The question is whether the next leg breaks below 50 sustainably this quarter, this summer, or whether one more consolidation pause comes first. Let me put the macro context around it, because the ratio doesn't move in isolation. Gold is at approximately 4,794. The Federal Reserve voted 8-4 on April 29th with four-direction dissents. Kevin Warsh confirmed under partisan vote, the first ever. The June 16-17 FOMC dot plot is the next major data point. The 30-year Treasury at 5%, April CPI at 3.8%, the fiscal deficit at $2.065 trillion, national debt above 39 trillion, central bank gold accumulation at 850-ton annual pace, COMEX silver coverage at 13.4%, ground beef at $7 a pound. Every macro factor strengthens the case for continued ratio compression. The Fed cannot raise rates without triggering a fiscal crisis, cannot cut rates without unanchoring inflation. The constraints have closed, and historically, when the central bank is trapped at this level of structural stress, the precious metals complex repositions, with silver amplifying gold's moves by 2 to 3 times. Here are the 4 signals that matter more than any forecast you'll read this week. 1. The gold-silver ratio on a sustained basis, currently 54.94. Watch for a sustained weekly close below 50, not a single-day spike. The late January 47.03 touch confirmed the structural compression. A sustained weekly close below 50 would confirm the acceleration phase. The data is publicly available on every major bullion site and updated continuously. 2. Silver-only price action on gold flat days. The May 11th move, where silver gained 7% while gold barely moved, was the cleanest possible signal of silver leadership. Watch for repeated instances. If silver continues to gain on days when gold is flat or down, the ratio compression is structural rather than tactical. 3. The 30-year Treasury yield, currently above 5%. Sustained yields at this level confirm the bond market is pricing structural inflation that supports continued monetary metal appreciation. Any reversal below 4.8% would ease the macro tailwind. Above 5.2% would intensify it. 4. Your local dealer premium on physical silver. This is the signal you can verify yourself this week without a Bloomberg terminal. If premiums on American Silver Eagles or generic silver rounds stay elevated or expand, While the LBMA spot price is flat or falling, the physical paper divergence is reaching your backyard. If retail premiums collapse, the paper price is winning the convergence battle. The dealer counter is where this thesis is most directly testable. Now I'm going to ask you two questions, and I want your honest answer in the comments. First, pick a ratio reading for September 30th, 2026. Commit to a specific number. 45? 40? 35? Or do you think the compression reverses and the ratio expands back to 70? Drop your number, drop your reasoning, don't hedge. Second, of the four signals, sustained sub-50 weekly close, silver-only price action on gold flat days, 30-year Treasury at 5%, or local dealer premiums, which one would most clearly confirm that the compression has entered acceleration? This question requires real thought because the answer determines what you should watch over the next 90 days. Now, what should you expect next? Expect volatility. Ratio compressions don't move in straight lines. The ratio could expand back to 60 if gold rallies harder than silver in a near-term flight to safety. The ratio could compress to 48 quickly if silver breaks above $94 on a weekly close. The path is nonlinear. Expect mainstream financial media to continue treating the ratio as a curiosity rather than a structural signal. The narrative will lag the chart by quarters. By the time the financial press acknowledges that silver entered a leadership phase in May 2026, the ratio will be below 40, and the easy gains will have been captured by the institutions that read the data correctly in real time. And expect opportunity to appear in the brief windows when the ratio expands rather than compresses. Counter-trend windows in structural bull markets are where positions get built. The compression to 54.94 is the consensus reading. The expansion back to 62 or higher, when it happens, and it will happen at least once before the next major leg, is the moment to add silver exposure if the structural thesis is intact. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what the gold-silver ratio is actually telling you right now. The ratio is at 54.94. It compressed from 62.05 to 54.94 in a single week on silver-only buying. The historical bull market compressions reached 17 in 1980, 31 in 2011, and 47.3 in January 2026. Silver outperformed gold by 2.2x in 2025. Bond yields are signaling sustained inflation. Ground beef is at $7 a pound. The 1971-style Fed paralysis just produced the most fractured FOMC vote in 50 years. Amateurs watch one metal at a time. Pros watch the ratio because it captures the entire metals complex in a single number. The amateur tape says gold and silver are both consolidating. The professional tape says silver is destroying gold faster than the financial press is willing to acknowledge. Silver has been monetary metal for 5,000 years. The gold-silver ratio has measured their relative value across centuries. The compression from elevated readings to bull market lows has marked the leadership phase of every silver bull cycle in modern history. The current reading at 54.94 sits squarely in the early acceleration zone, below the post-2000 average, but well above the historical peak compressions. The trajectory is downward. The structural drivers are intact. The pattern is reassembling. So here's the clean summary. The gold-silver ratio is at 54.94, compressed from 62.05 in a single week. The May 11th move was driven entirely by silver, while gold barely moved. Silver outperformed gold by 2.2x in 2025, 144% versus 65%. Historical bull market peaks featured ratios of 17 in 1980, 31 in 2011, and 47.3 in January 2026. The 30-year Treasury at 5% confirms structural inflation. Ground beef at $7 confirms the consumer-level reality. The Fed is trapped at the 1971-style threshold. Comics coverage at 13.4%. Central bank gold accumulation at 850 tons annually. The institutional bull voices are intact. The mainstream financial press is calling the ratio consolidating. The chart is calling it the early acceleration phase of silver leadership. This is where the serious holders of monetary assets separate from the tourists. The tourists watch one metal. The serious holders watch the ratio. If you want the next breakdown, the moment the ratio breaks below 50 on a sustained weekly close, the moment silver decouples again on a gold flat day, the moment the June dot plot lands, the moment the compression converts from consolidation to confirmation, subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the headlines do. Drop your September 30 ratio target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.